Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, registered investment advisors, family offices, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Robb, you are on the road today. Where are you recording from?
I am on the road, Gary. I am right in the heart of San Francisco today. I'm actually at what's called TechCrunch Disrupt, one of the largest tech conferences, I think, in the world, actually. We're here to support a client of ours. It's called Narada AI, and they're actually a part of TechCrunch's what they call Startup Battlefield. We found out today that they're actually a top 20 finalists, and they're going to be pitching tomorrow on the big main stage at TechCrunch Disrupt for opportunities for some nice capital injection and obviously just visibility. So yeah, it's been a lot of fun being up here on the road and supporting them at the conference. And fingers crossed, hopefully we can bring it home. So yeah, it's been whittled down from a couple thousand entrants. We made the top 200. And then now into the top 20. So yeah, it's gonna be fun for the next couple of days.
Rob, is that the company that does the AI note-taking app that integrates into Zoom so it just summarizes everything you're talking about?
Yeah, so there's a lot of those that are out there in terms of the note taker type apps, right? But what Narada is actually doing, that's really just tip of the iceberg. So it's taking notes and then taking the conversation and any sort of tasks that might be related to you and I even talking on this particular show, let's say, and actually automating those tasks. So Flying V Group, we actually use it quite often just within our tech stack to where it'll record the conversation, pull out key action items, and then actually facilitate those action items through the AI worker. So if it's scheduling a meeting, sending an email follow-up, passing the notes from the call directly into a HubSpot, or we use Jira for project management. So yeah, we've seen a lot of good performance with the tool. Definitely has helped our efficiency, accuracy, probably right, of getting the information right for our clients and whatnot. But yeah, that's even kind of the tip of the iceberg explanation too. But full blown task automation off of unique human conversations like we're having now.
All right, let's try it out. Let's try it out right now. We're going to do this live on air. Here we go. Narada note taker, please have Robb Fahrion contact the management team and get them to pay Deep Knowledge Investing marketing dollars for this segment where we're talking about what the product does.
Perfect. Yeah, I think it's actually queued up right now. And then I see Dave over there in the corner, the CEO. I think he just got that notification. So we're ready to rock and roll with
Good.
Narada.
So basically what you're telling me is that if funds hit my account by the time we're done filming this, then it's a good product and it works. And if no funds hit my account, then nobody should use it because the product doesn't work. Is that what you're saying?
Definitely not saying the latter, and I guarantee you those funds will end up somewhere if that means that if the product works, and that's a good omen for tomorrow when we're doing the live demo.
All right. Good to know.
Gary, we got a fun episode. Thanks for accommodating me while I'm on the road, and yeah, it's been fun here. So appreciate your flexibility. But this week we got another great episode of the five things. We're calling this the Bond Bears issue. We got a lot on the docket for today. We're talking Las Vegas Sands, DKI portfolio company. We've got Starbucks making an appearance, talking about some highly regarded investors. Again, inflation, energy, constant theme on our show. And as always, we're helping with investor education here at the end. Active versus passive investing. We'll cover a little bit about that towards the end of the show. Gary, are we ready to rock and roll?
Let's go.
All righty. Gary, thing number one, we're talking Las Vegas Sands. You're saying they got a little bit unlucky at the gaming tables. We think that's temporary. Thing number one, Gary, Las Vegas Sands, ticker LVS earnings, LVS being a DKI portfolio company.
All right. So for the people who are new here coming in, we've added our subscriber list recently. Las Vegas Sands is one of the largest gaming companies in the world. By gaming, we're talking about casino gaming, not video games. and they have leading market share in Macau, which is the largest gaming market in the world. And they have the Marina Bay Sands in Singapore. It is one of only 2 casinos in Singapore. That market is almost the same size as the Las Vegas market, but with just 2 casinos. So the Marina Bay Sands there, it's sort of like the equivalent of owning the north end of the Las Vegas Strip, if that gives you a sense. So they announced third quarter earnings last week, and the headlines looked pretty bad. Revenue of 2.7 billion was below last year's 2.8 billion. It was below analyst estimates. Adjusted property EBITDA of 991 million was below 1.12 billion we saw last year. Adjusted earnings of 44 cents was below last year's 55 cents and fell short of analyst estimates of 53 cents. So, Rob, that seems pretty bad, right?
It does. It does. But what happened was a little bit of a different story, which I think, Gary, is what you've been hitting on and that the market has been missing and what you like about LVS.
Yeah, so this is one of these situations where it does pay to do work beyond the headlines. The headlines numbers look bad. When you do the actual analysis, it was a fantastic quarter. And by the way, I'm going to give the market credit. The market was smart on this when they saw through the negative headlines. The stock was up right away in aftermarket trading. It's been up most of the days since. This is a stock that was at $38 a couple of months ago, and it closed today. Actually, let me take a look. I want to say right around 54. Yeah, closed 53.62, 54 offered. So, the market actually is starting to understand the story here. In my opinion, there were 2 key things that happened. First of all, I know this is going to sound crazy, but casinos, just like individual players, can get lucky or unlucky at the gaming tables. And the way that casinos measure that, it's something called hold. When you look at a very high hold, it means the casinos took in more money than they should have based on how much was gambled. A low hold is the opposite. It means people gambled a lot, but they won more than they should have statistically. And the most recent few quarters, Las Vegas Sands has had a really good hold. They have kept more money that's been gambled than statistically they should have. Well, this last quarter was the reverse of that. And if you adjust for hold for the last 5 quarters, so for the 4 quarters running into this and then this quarter, what we see is that earnings per share were actually up about 10%. It went from 50 cents to 55 cents. That's adjusting both the third quarter of last year and the third quarter of this year for hold. Now, the reason that's significant is something we've talked about a lot is Las Vegas Sands has 2 properties in Macau under major construction. And they have thousands of rooms out of service right now because they're being renovated. They're adding new suites. Well, guess what, Rob? They're already starting to add some of those rooms back into service. And by the time we get to Chinese New Year in the first quarter of next year, so in the next 3 months or so, they are going to have almost all of those rooms and more suites back online. And so basically, these guys beat their earnings from last year effectively with one hand tied behind their back. Really good to see. The other thing I would add is Las Vegas Sands has always been a very shareholder friendly company. They have bought back hundreds of millions of dollars of their own stock, hundreds of millions of dollars of Sands China stock, which is the holding company that owns a portion of the Macau assets. They have restarted the dividend and increased it for next year, and just done all kinds of these things. They have at this point returned more than $1.5 billion to shareholders this year. The company financially is in great shape. They're doing construction in Macau, in Singapore. They're growing. They're adding. To me, looks like everything is working. The one last thing I would add is we just got through Golden Week, which is a big gambling holiday in Macau, and the visitation they saw exceeded the pre-COVID 2019 numbers. We think the company's in a great position right now, and the stock, despite being up a lot, still seems like people think it's a distressed security. And I don't think you missed it. I'd be buying it here.
Great signs there on LVS. Gary, one additional question on the hold. When they're accounting for that, I mean, do they have like a baseline that they account for when it comes to like forecasting, and then are just adjusting based on the actual results, or how do they kind of forecast or even account for that?
Yeah, that's exactly what they do, Rob. So what they do is they take a statistical average and then have a range around it. And they say, based on the games and where we are, the hold should be between a certain level and another level. If it's within that level, they basically say, okay, we're just going to take the number. If it's outside of that range, then they tell you how much they were outside of that range, and you can adjust up or down depending on whether they had a high hold or a low hold. The company used to give more data. They would give you adjusted earnings based on that. And recently they stopped doing that. They stopped giving you hold adjusted earnings. I think the SEC didn't like it, but because they give you the raw data, if you have a good model and you know how to do the analysis, this is a calculation that I've been doing. I've been following this company for more than 10 years at this point. So, my model goes back pretty far, and, these are calculations I do all the time. So I think, they don't give you the answer, but they give you the data that you need to come up with the answer.
Sure, sure. Great things coming out of LVS. Great signs for things moving forward. No change from the DKI side in terms of our recommendation of LVS. Gary, thing number 2, we're shifting to Starbucks, ticker SBUX. Saw same store sales down about 7%. You're saying that's a big problem. You even mentioned that you were surprised that the stock was only down about the 4% it was after this announcement. Thing number 2, Gary, disappointingly pumpkin spicy earnings from Starbucks.
By the way, Rob, we got to credit the interns on this one. It was a clever title. And I
Great
actually thought it
timing
was
as well.
Alex. I wrote Alex a note saying, wow, clever, great job. He wrote me back. He said, no, Andrew wrote that one. So, the good news is both of our interns are writing, clever, interesting, funny titles. Couple of smart young men, as we've said before, really proud of both of them. I had a nice exchange on Twitter or X with Amy Nixon, whose work I really like and respect. She's Texas Runner DFW. I think that stands for Dallas Fort Worth. Recommend following her. I really like her work. She posted another spooky earnings report from our favorite pumpkin spice distributor. Starbucks reports declining revenue again. Earnings per share fell almost 25%, and they're ghosting us on forward guidance for 2025. Starbucks shares down 4% in after hours trading. Give her credit. It's really well worded. Alex and Andrew, I think, may have learned their headline writing skills from Amy Nixon. My response to her was earnings per share of 80 cents versus estimates of $1.03. Same store sales down 7%. That is a huge number, Rob. Guidance pulled. Stock's still trading at 24 times next year's earnings, which will need to be revised down. I was shocked the stock was only down 4%. This was a bad quarter from one of the largest consumer service companies in the world.
Gary, I know CEO Brian Niccol, he's been really focused on kind of the internal dynamics, right? Starbucks is one of those companies that has got involved in a lot of the social aspects. How much of this could be kind of a similar Bud Light story that we have going on with Starbucks in terms of how they kind of plant their flag in the ground?
I think a lot of it. And look, we can't prove it, but that's my view on it. First of all, let's talk about how Brian Niccol got the job. Starbucks, he took over the job just weeks ago. Starbucks' most recent CEO somehow decided it was a good idea to put out in public that anybody contacting him after 6 p.m. better have a good reason. That strikes me as completely insane. He's running one of the world's largest multinational companies and is saying, don't call me, before the evening news. I mean, Rob, you and I regularly, when we have stuff to talk about, we talk on the weekends. My interns call me at 11 o'clock at night. Jordan, one of our old interns, and Danny, those guys used to text me information at 3 a.m. I would respond. What is this 6 o'clock? It's fine. If you're an hourly employee and you take off, that's cool. I respect that. No problem. You're running a big business.
Yeah. I think it's one of two things. Either either Brian Nickel needs to work a little bit longer hours or open up those office hours, or you and I need to get paid a little bit more. One of two things.
Yeah, there you. But just for you're right, Rob. But just for clarity, that is not Brian Nichols' fault. That's how he got the job. He was not the 6 p.m. CEO.
Got
Uh,
it.
he may turn out to be a good or bad CEO, but lack of work ethic has not been an issue with him. So let's not tag him with an unfair label so far. But I think Starbucks has two problems, Rob, and let's talk about it. First of all, Starbucks, their product is very, very expensive for what it is. When you and I think about getting a coffee, like, I'm typically thinking, okay, it's a coffee. What's it going to cost? $1, $2, something like that, depending. You walk into a Starbucks and it's very easy to have individual drinks be $5, $6, $7. You buy a drink and a small food item, all of a sudden you're in for $20. It's, all of a sudden for a fast food snack, you're in the range of like those incredible, you've seen like the Five Guys receipts where like a burger, fries, and a drink are costing people $22. So they're a very high priced luxury item in an economy that's weak, that's not doing well. They're also getting clipped, I think, by the fact that, we still haven't had a full return to office. A lot of offices are, 50, 60, 70% empty. That disrupted people's regular patterns. And then beyond that, for years, Starbucks has aggressively involved itself in controversial social and political issues, alienating about half of their potential customer base. And, look, I can tell you, I stopped going to Starbucks years ago when they decided that when you walked in, it meant that your barista was going to talk to you about racial issues. And here's the thing. Like all of us, like everybody listening to this, like everybody's part of the deep knowledge investing community, we're all in favor of racial equality. We're all in favor of treating people with dignity and respect, regardless of their race or their national origin, their background. But if I walk into a Starbucks to get a coffee, that's not what I'm there for. I don't want to wade into our society's most difficult social and political issues when I decide I want a latte. And it's just a mistake. It's a mistake to try to force people into constantly talking about these things. And it doesn't mean people are against you. It just means they don't want to always be. And my Starbucks barista isn't the person I want to have that conversation with. There are people I may want to have those conversations with, but it's not the guy making my drink at Starbucks. So I think it's a mistake on their end. And, they're not the only ones. Other brands and companies like Bud Light, Target on the left, My Pillow and Goya on the right. And by the way, I don't think Goya's on the right. They ended up in a controversial situation simply because they were praised by President Trump and returned the compliment. But these companies have all faced customer backlash because they were involved in social and political issues on both the left and the right. My view on this stuff is it's much better if you are a customer service company to focus on providing people with a great product at a good price rather than trying to wade into these issues. And by the way, that's what we do here at Deep Knowledge Investing. When we bring in a new customer, a new client, a new subscriber, I don't ask them about their racial background. I don't ask them about their sexual orientation. I don't ask them whether they vote for Democrats or Republicans or what their political views are. We have one goal. That is to help those individuals make money. That's to help those individuals get better returns. When we talk about these issues, our view on this, we talk policy, not politics. If a politician has proposed a policy that affects economics, we're going to talk about it. But we're not going to say this person's an idiot, they're a bad human being, you should hate them. We don't want to be involved in that because at Deep Knowledge Investing, we serve people on both the left and the right side of the aisle. And that's also seen in our board of advisors. On our board, we have people who have served in the Oval Office for both Democratic presidents and Republican presidents. We have people who have worked in the Obama administration, the Trump administration, both Bush administrations, people who work directly with Joe Biden. we're not going to ask people those questions. It's our job to serve everyone with respect.
Yeah, I think you nailed it, Gary. I think another component, at least for me personally, too, is it's just lost that kind of local coffee shop feel as well, right? A place where you could go, sit down, relax, get some work done. Now it just seems like cattle call, right? Run as many of them through as quickly as we possibly can. Customer service has fallen off. And then sometimes I'm not sure whether or not I'm in a Starbucks or a Dairy Queen with some of these frappuccinos and ice creams or whatever it is they're selling. So interesting stuff happening at Starbucks, and we'll be sure to stay in tune with any new developments
Yeah,
there.
I think they're selling sugar masquerading as coffee.
100%.
Right, you think coffee, like, you don't think, "Oh, that's unhealthy, a certain amount of caffeine." My view, listen, you guys check with your own doctors. My view is a certain amount of caffeine is fine for you. There are certain benefits, certain risks. Okay, fine, but it's not a high calorie drink. But these guys, they're basically serving dessert masquerading as, morning coffee. It may not have the health benefits you think.
100%. Yeah, lots of issues over at Starbucks. We'll see how they handle those. Remember as well, take a moment. If you haven't already, subscribe for our free newsletter online. You'll get access to all the different material that we're posting. But in order to get complete full access, unrestricted, become a premium subscriber of DKI. You'll get access to all the current recommendations, when Gary's buying, when Gary's selling, and any unique information that's coming out goes out to all of our premium subscribers and definitely goes out to them first before anyone else. Gary, thing number 3, we're talking about some market giants, Paul Tudor Jones, Stanley, Druckenmiller. You're saying, hey, avoid treasuries. DKI agrees with them. Thing number 3, Gary, all roads lead to inflation. Strategic bets from 2 market giants.
Yeah, so Paul Tudor Jones is one of the godfathers of the hedge fund business. He's been incredibly successful for a long time. Stanley Druckenmiller generated great returns for decades at his former firm, Duquesne Capital Management. Paul Tudor Jones was talking a week ago saying all roads lead to inflation. And he talked about investing in gold and Bitcoin and that commodities are underowned and saying he owns zero fixed income. The guy, I had people DMing me on Twitter or X saying, is this guy a DKI subscriber? Because that's where we are. We own gold, we own Bitcoin, we own energy. We do not own fixed income. So round of applause for Paul Tudor Jones. He either has a DKI subscription or clearly doesn't need one because he's got his act together. Druckenmiller, a guy again who generated great returns for decades, is saying the way for the government to navigate the current economic landscape is to inflate your way out. I agree with that, and we're going to talk about it in a second. He's actually shorting U.S. Treasury bonds. I agree with that decision as well. I'm not personally short treasuries, but I like the call on that. In his case, it's a giant position. It's 15 to 20% of the portfolio. And the reason he's saying inflate your way out, that is where we are. We've got, roughly a $28 trillion economy or so, but a lot of that is government spending that's inefficient and wasteful. National debt right now on balance sheet is about $36 trillion. When we include off balance sheet liabilities, things like Medicare, Medicaid, Social Security, Obamacare, or the Affordable Care Act, pensions, those are over $200 trillion. The liabilities of the US government are about $250 billion. If that's incomprehensible to you, that's because it's a number too large to be comprehended. It also is a number that cannot be paid back. And so we can either be like Argentina and just default, which is not going to happen. What we're going to do is print more dollars, flood the system, technically pay off our debts, but print so many dollars to do so that the value of those dollars would decline. One of the things that DKI has been screaming about for years is you cannot save in dollars. You can't save in fiat. The dollars that you hold today will have less purchasing power a year from now. So you need to find other options. Now, is that fair? No. Is that right? No. If you feel like you're getting screwed, You are. But the fact that it's not your fault doesn't mean that you don't have a responsibility to do something about it. This is how we help people. We help people figure out, okay, what do you need to do in order to preserve purchasing power, in order to actually have to grow wealth. And when I talk about growing wealth, I don't mean just the nominal dollars in your account. I mean the purchasing power.
Gary, DKI has been talking about inflation for seems like 2-3 years at least, right? With these two, Druckenmiller, Paul Tudor Jones, are they late? Why are they just now saying this now? Or maybe on the flip side, what was it that DKI saw so much earlier than a lot of others that kind of opened your eyes? Even I know you've been pounding the pavement saying this is what's happening, this is what's happening, this is what's happening. Now it seems like things are more mainstream in terms of the position that DKI has had for some years now.
So, Rob, it's a great question. In my opinion, I don't think Druckenmiller and Paul Tudor Jones are late. I think all of those trades, if you're just coming in now, like I own Bitcoin. If I didn't, I would buy it today. I own gold. If I didn't, I would buy it today. I own energy and commodities. I'd be buying them today. I wouldn't be buying fixed income today. So I don't think they're late. I think we were early on it. We were early and right. And the key thing is that the government has just been increasing the money supply, pouring stimulus into the market. That was always going to create an enormous amount of inflation. And something we talked about in last week's issue, Rob, is the fact that the Fed lowered interest rates, and yet the yield, the rate on every Treasury security from 1 year to 30 years went up. And so why? If the Fed lowers rates, shouldn't we have lower mortgage rates? Shouldn't the 30-year be lower and the 10-year be lower? And instead they were higher. And the reason is because the bond market is smart. And they correctly understood that lower rates with this amount of government stimulus and congressional overspending, which is a bipartisan problem. It's a problem for both Team Red and Team Blue. That means too much stimulus, too low interest rates, and you're going to have more inflation. And so, the yield on the 10-year went up when the Fed lowered rates because the market was correctly adjusting for projected higher future inflation. I think we understood it early and we were right, but I don't think Druckenmiller and Tudor Jones are late. I think these are good trades right now. And if people are just coming in now, I don't think you've missed it.
Great stuff. And as we've mentioned, yeah, Gary, you've been saying this for years now. But again, as Gary's mentioning, still opportunity exists and we'll still be doing some of the same things we were doing 2-3 years ago. Gary, thing number 4, recently, I know you're super close with Michael Gayed of the Lead Lag Report. You were on his show recently talking a little bit about inflation and energy. Michael runs at Lead Lag Report on X, does a great job. Thing number 4, Gary, tell us more about that. DKI sits down with Michael Gayed from the Lead Lag Report.
Yeah, thanks, Rob. Guy's terrific. He is one of the hardest working men in finance. If you don't follow him on Twitter or X, it's at Lead Lag Report. I recommend following him. He does a fantastic podcast. He gets interviews with everybody, really just about anybody who has a big profile in finance has sat down to talk with him. He does long form interviews, none of these, like 3-4 minute TV segments. When you're talking to Gayed, you get a solid hour of great, well-prepared questions. He gives people a lot of space to talk. And he's been kind enough to have me on his show at least 3 or 4 times, maybe more. I don't even remember now. It's something I really appreciate. So the key thing that we were talking about during last week's episode, which we filmed a couple weeks ago, is actually inflation, which is what we were just talking about with Paul Tudor Jones and Stanley Druckenmiller. And one of the things I talked about is that I think the current inflation surge is being driven by excessive government spending. And that's illustrated by the fact that over 50% of all dollars in existence were created in just 2 years. Now, there's been a lot of debate on this, Rob. There are a lot of people in public and on Twitter or X, I never know what to call it these days, who are saying No, 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 government spending is fine. It's fine for the government to do all this. It really was just COVID and supply lines and supply chains. And the reason why I don't believe that answer is because if the inflation that we had was driven by supply chain issues, and those are issues in 2020 and 2021, then what we would have seen in 22 and 23 when those things got sorted out and everybody went back to work and economies reopened and shipping rates came down and supply lanes open, uh, what we would have seen is that prices would have come down. And here's how you know that. Let's talk about a practical real world example. Let's say, you're in Florida and there's a gigantic hurricane coming, and often they get warning a week in advance, they know. And so what happens? Everybody goes, they want to buy supplies, they want to buy generators, and the price of those things goes way, way, way up. And then they get through the storm, and the storm is done. And what happens then? Those prices come back down because the supply issues get evened out over time. And that's what happens. But that's not what happened here. Once, we had those supply shocks of 2020 and 2021, they got alleviated. Prices should have come back down, but they haven't. What we've had is not deflation, which is what we should have had if those critics were right. We've had disinflation, which means we've had continued price increases just at a lesser rate. So, the CPI went from 9% to 3% to 2.5%. Okay. But we still have price increases. And the reason for that is massive amounts of government spending. And so, that is what I think is going on. I think the proof I've given is the right way to think about it. Believe it or not, people are still debating this. And, fortunately with Guyed, when you have an hour to talk with somebody who's as knowledgeable as he is, you really get a chance to go through these issues in detail and lay out your thoughts. For people who are interested in seeing that episode, it is up on YouTube. So if you just go to Lead Lag Report and just look at what he's done over the last few weeks, or put in my name Brode on his channel, you'll be able to find it. And we were able to go on at length on that.
Yeah, the link to the interview as well is in the written version of the 5 things. So again, if you haven't already, you can subscribe for a free subscription on the DKI website. That'll actually get you each weekly version of the 5 things. That's not a gated content piece that we produce here at DKI. Gary, I was watching the interview with you and Michael Guyed, and you also talked about energy and specifically uranium. Can you fill in our viewers that may have missed the interview or haven't seen it yet on that conversation?
Yeah, Rob. So, we've owned uranium for 3 years, and it's something we talk about a lot on this show. Basically, with uranium, we're looking at a gigantic supply demand imbalance. Right now, the world produces roughly 30 million tons a year less than current demand. And so let's talk about what's happening to demand and then what's happening to supply. On the demand side, countries like India and China, they want to industrialize, they want to ramp up their energy needs, they want to provide their citizens with a better material quality of life, and that means more energy. A high material quality of life and energy use, that correlation is almost 100%. On top of that, we have a shift toward green energy. People, right or wrong, people are very worried about carbon dioxide and carbon-based energy sources. Well, nuclear is the only reliable energy source. Hydroelectric is pretty good too, but it's the best reliable energy source for non-carbon needs. And then, we've seen everything happening in the AI space. Everybody over the last couple of years have been focused on AI, and it, led to NVIDIA's rise and a whole bunch of other companies. Within the last few weeks, Microsoft, Google, and Amazon have all contracted to buy nuclear power. In the US, there are 3 places that are trying to do something that's never been done before. There are 3 decommissioned nuclear plants that they are trying to recommission. So there is just very rapidly increasing demand for nuclear energy. On the other side of it, we're supply limited. In Canada, their largest producer, Cameco, is not producing more. And in fact, Cameco is actually buying uranium at a loss in the spot market to supply uranium to their customers. Basically, they're saying rather than mine more, we'll just buy in the spot market and lose money to fulfill our contracts. We've talked about Kazatomprom, which is the world's largest producer. They just cut production, partly because they don't want to mine more, and partly because they can't get enough sulfuric acid to process the raw uranium. So, what we're looking at here is a market that has supply and demand out of balance, and demand is growing quickly and supply is not. It's going to get worse, and we think that means higher prices.
Good stuff. And again, if you haven't seen it, you can check out the full interview on the Lead Lag Report YouTube channel. And again, in the written version of the 5 things, which will also be up on the DKI website, you'll have a link available there to find that content and information. Definitely recommend checking that out anytime Gary and Mike will have a conversation. It's something you don't want to miss. Thing number 5, Gary, as we've continued to move forward, in our investor research education piece. We've got another great question that we're coming in for our 5th thing. We're talking active versus passive investing. Gary, thing number 5, tell our viewers out there, what is the difference between active and passive investing?
So, Rob, this is a question that came in from, one of our younger, inexperienced readers, and it's a really good question. So, as somebody who grew up in the hedge fund business and was a portfolio manager and ran funds, I was always an active investor. It meant that in my case, I was running a relatively concentrated portfolio where I was selecting individual names and picking the exposures that I wanted. And, at times actively trading things, other times I would, hold for longer. But there's an art to it and a lot of work, and it's very difficult. The advantage is that if you get it right, you have phenomenal returns. And at Deep Knowledge Investing, one of the things we've talked about is we have had in 5 years more stock picks that have gone up 100% or more than we've had picks where we've lost money. So, you do that and you can beat the market. Now, the downside of active investing is things might not go well and you could have some bad picks. And by the way, we all have, I don't know a single portfolio manager, we've all gotten things wrong and sometimes badly. And when that happens, you can trail the market and that frustrates people. People don't like losing money, but they really don't like being down more than the market is. And, that can be a challenge. Passive investing, those are people who are buying mutual funds or exchange traded funds, or typically index funds. They might buy SPY or QQQ for the S&P 500 or the NASDAQ 100, and those exposures are set. And so if you buy those, your return is going to be the market return, less typically small amounts of fees. Now, some of these funds have a bad fee structure, but a lot of them have very low fees. The advantage of it is you don't have to do what I do, which is work 15 hours a day looking for great ideas and doing research. You just, it's like set it and forget it. You buy it, you're going to own the market return, and you pretty much leave it alone. The downside is you don't really have control over your exposures. And the way these things work is they tend to be market cap weighted. And the reason that's important is because as a company becomes more overvalued and larger, it takes up more space in the index. And so you're constantly, if you're indexing, if you're passive investing, which is indexing, what you're doing is you're increasing your exposure to the most overvalued names and decreasing your exposure to the most undervalued names. And that's what happens over time. And that's the risk of that. And so, my view on this is like everything else, both strategies, active and passive, have benefits and detriments, and you need to know what's right for you. And if you're a professional investor like me or my peers, we like active investing, and that's the direction we want to go. But for somebody who isn't doing this all day, passive investing could be a good option for you. Again, you could be okay either way. You just need to know what your goals are and what your core competency is.
Gary, as someone that is not a professional investor, how much do taxes play into active versus passive investing? Because as someone that is a novice, like, are there certain tax implications that active traders need to be more aware of than passive traders?
Well, you have more control if you're an active investor than a passive investor. So let me give you an example. Um, let's imagine, that you're a passive investor, you own an exchange traded fund, or you own a mutual fund, something like that. If they have gains throughout the year, which is not a bad problem to have, you get the tax bill even if you haven't recognized that gain. And so you could be in a situation where you're invested in one of these funds. You don't sell anything, you don't have more cash, but you get a tax bill. And you put that in, you fill it out when you fill out your 1040 form with the IRS in April. And when that happens, you're going to be paying out of your pocket, and people may not like that. The advantage of active investing is, while it doesn't enable you to not pay taxes, it does give you a little more control. So, let me give you a couple examples. One would be that long-term capital gains taxes are much lower than short-term capital gains taxes. Now, there are exceptions, and I'm not a tax advisor, but in general, that's how these things tend to work. Well, the difference between long-term and short-term is 1 year. Let's say you own something you'd like to sell and it's up a lot and you have a lot of gains, and you've owned it for 360 days. You might hold that thing for another 5 days, get long-term tax treatment, sell it, and reduce your tax bill. I'll give you another example. Let's say, this year, 2024, we've had a good year. We have a lot of gains. We're going to be in a high tax bracket. And, it's late December. You're looking at selling something else and recognizing gains, but you're going to pay a lot of taxes on it. You might delay by a week or two and sell it in January and not recognize as much in capital gains this year and have some for next year. One other example, let's say, we're rolling into the end of 2024 and you've had a good year, you have a lot of capital gains. So terrific, good for you. But, say you have a position on your sheets where you have an unrealized loss. You have the option before year end to realize that loss, to sell that position, take the loss, and reduce your tax hit. So with active investing, it doesn't allow you to avoid paying taxes, but it does give you more control over when you realize those gains or losses, the way that you do it, whether you do it in this year or the next year, how you offset them against each other. And whether you can hold on for a little longer and get long-term capital gains treatment, which is, again, I'm not a tax advisor, but that tends to be more tax efficient. So, these are things that, is it hard to manage all that? No, but you do need to know something about tax, accounting, portfolio management. It's something you need to think about and keep track of. And, these are things that as a portfolio manager, I do. And, I don't think if you're listening to this, it is not beyond you to do this, but it also doesn't take care of itself. It's another thing that you have to do, but if you're willing to do it, you have more control. You know what it's like, Rob? It's the difference between driving a car with an automatic transmission and a manual transmission, right? The manual transmission is more challenging to drive. You can't tune out. You have to have both feet and both hands engaged, but you have more control over the vehicle. That's the best analogy I can come up with for that.
Awesome. Love it, Gary. Great analogy. And thanks for that. Thanks for clearing that up. That will conclude this week's version of the 5 things. Again, this was the Bond Bears issue. As always, be sure to subscribe to where you can get the 5 things directly in your inbox each and every week. And Gary and I will continue to keep the pulse on the markets and bringing you the most important things to know for any given week. Gary, any closing thoughts before we sign?
Yeah, I want to thank Michael Guyot again for having me on the Lead Lag Report. Always appreciate when he brings me in for his show. Great talking with him. Thanks also to Amy Nixon, what is Texas runner DFW, I think. You know,
Yes.
for the fun exchange on Starbucks. She's worth following as well. Round of applause as usual to Andrew Brown and Alex Petro, the great DKI interns who were very fun and funny this week. Great work by both of them as always. And Rob, you know, I know you're traveling, you're at this fantastic conference, and as always, you make time. And for the people watching this, thank you so much. We know your time is valuable. We appreciate you spending it with us. If you want to like, comment, subscribe, we'd be happy to have you more involved. And also for the people who, there was a Bitcoin segment we did last week that ended up getting a lot of attention and a lot more likes than usual, a lot more comments. For the people who chose to engage, thanks. We really appreciate you, and thanks for being part of Deep Knowledge Investing.